Good morning, everybody. Welcome to the Flow Show. Another busy day ahead, another busy morning for yen traders. Morning to the guys, Kay and Stel.
Hey, guys.
Good morning. Hello.
Everybody.
Yeah, all having a good morning.
Yeah, all good. Getting ready for the event starting tomorrow. There's lots of things to do, but very excited about it.
Yeah, me too.
Yeah.
I'm sure we're going to have tons more. It seems like everything I want to talk about changes day by day. keep writing things down that I'm going to discuss with people, and I've got about 1 million questions and 1 million different topics. It all seems to change, but that's trading, that's markets. We just deal with what's in front of us, and on that basis we'll get right into it. Starting with the Pboc and China, they left their LPR rates unchanged overnight, mostly expected. Obviously, with what's been going on, they've been on a bit of an easing path. There was a bit of a chance that they might cut rates, but it was expected unchanged, and they left them unchanged. We did get a bit of news. I won't call it news because it came from Bloomberg, that China might debate cutting COVID quarantine for visitors from 10 days to 7 days. A lot of people put a move in the yuan on the back of those headlines, which might be a bit of an overreaction, in my opinion. We're talking this move down here. Quite a swift move, but a lot of people have drawn the conclusion that, oh, this means the start of the end of the zero COVID policy, which I think is a load of hogwash. That's already been partly reiterated at the People's Congress, and this is really only just cutting quarantine for people turning up in the country by 3 days. It's not a big reversal. The market has undone quite a bit of that move anyway, but quite a steep overreaction and a bit of a signal to what may happen if they ever move from their zero policy and make things a little bit more open and easier regarding COVID. In the meantime, from just looking at China overall, we still have this Congress going on, so I'm a bit loath to trade it here at the moment, pending any further headlines going on. Obviously, we've got the dollar side and the yield side playing out in this story as well, so that's why I'm a bit neutral, sitting on my hands regarding this pair. Over to the Bank of Japan, they announced an unscheduled bond buying bout last night. They're really seeing a bit of pressure coming in on yields. We saw yesterday that the 10-year yield got above the ceiling. 0.25% was trading up to 0.255%. There's been a bit of a few eyeballs on the 20-year as well, ticking up fairly high again. So the BOJ stepping in just to remind everyone that they're still there buying it and trying to keep yields contained. Obviously, the big news this morning regarding the price is that the 150 has been broken. So that's been put to bed, at least short term, in terms of barriers and everything else going on at that level. A little bit of a stock run through perhaps to an 07 high. Not as much follow through as perhaps might be expected, which might suggest there's still a bit of a wall of offers up here. The market tried to trigger probably some bigger stops a bit higher up. Couldn't manage that. We're back below. We've had the usual officials out last night, and we've had them out again since the break of 150. Now, of course, they're not putting a number on anything they do, but the fact that they came out with the same old lines, not going to comment on FX, not going to comment on whether they're intervening or not after the 150 break, I thought that might induce a bit more buying and another go at 150, just on the basis that they're showing no interest in that number breaking. That hasn't happened, so there is still a lot of selling going on up here. We're not obviously dipping that far back, so the buyers are coming back in. It is a good battle going on here. It's a bit of a popcorn watch going on at the moment, but certainly no sign of that we know of any intervention coming in at the market at the moment. Before we move on, what do you make of it, Kay, this morning?
Well, yeah, they might have been they might have given a few orders in there just to prevent the 150 to break significantly. It's a bit of a typical barrier hunt, but I don't think, unless it's really their offers, that there was a lot of Japanese corporate involvement at the 150, which I would have expected that there might be. They can put in place what we call power duels, and I could go into detail regarding those kind of options, but basically they put ranges in place on the dollar yen for which if the dollar yen keeps in that range, they're getting higher returns than the 0% of the order, minus 0.10%, and for that they pay a premium. But typically at how shall I say, crossroads, like we are here at 150 big psychological level, I was expecting some of those perhaps to be there and a quick stop run through 150, but it doesn't seem that they were that big, at least if there were any, because otherwise we would have seen a bigger stop run through there. Traditionally. So yeah, I don't know. After all, it's just a level, right? And if you look at the pure technical side, 150, there's not a lot to see here. It was rather 149.40, and then the next one 150.35 or so. Okay, it's still a big psychological level. But yeah, but really buyers, unless speculators and players. I don't know. I think the more medium-term guys, if they are really short a lot of yen, they might not be chasing it here and just sit on their hands and gradually buy a bit more. CTA accounts will probably keep a bit under it as well, unless we start to go back below 149.40, in my opinion, 30.40 around there. That may be a bit of a turnaround, or at least for temporary shying away from the 150 level. But I'm not going to read too much either into the comments. It's just their daily comments. They're seeing dollar yen go higher. So there's just there's nothing new in the Japanese comments, right?
Yeah, no, agreed, mate. And just to answer Karen, yeah, I did my 150 scalp. I got in last night at 89, and then a bit more after that overnight. But then I cut half that position this morning, just on the price action. When I trade big figures, and I trade big figures a lot, and not every big figure, but I like to trade the ones that haven't been traded for a long time, and I'm talking maybe months or years, and the big psychological ones like this 150. Now, the thing with big figure trading is there's really only 2 or 3 things that happens. What happens is on a first test, you sometimes get it up maybe 90s, 95s, then it gets a slap down 20, 30, 40 pips, depending on how big a level it is. That's the sort of move I'm looking to scalp on a big figure trade. That first rejection where whatever's being defended up at that level sends the market down a good 20, 30, 40 pips, and you can make some money. What I don't like is when you get this move up to a level and it gets close up into the 90s, 92s, 93s, and it just sits there and sits there and sits there and sits there with really no pushback. And when I see that, I start to think, well, maybe I'm not going to get the trade I'm after here. So just before we got the break, I cut my scalp on the big level down to half the size because I thought we were getting the break. We did get the break. It wasn't a big break, and then I did manage to nick some out on this move down for 17, 16, 70 pips for a bit. Not huge money, but I'm there to scout the level. That was my intention, so I got a bit of money off. And and I'll see what happens to the rest of it from here. And I'm looking to fold some of this into my core short anyway. So yeah, I did get a bit, but I am cautious. It's all about the price action when you watch these levels. This is why I watch a 15-minute chart in particular, because it gives you the decent price action, and that price action suggested we were getting a break. And as I said, I mentioned that very thing in the room before it did break. But yeah, it is the case of diminishing returns on the next test, because we haven't dipped far from the level. So Kay's saying it needs to move under 40s odd to really change this mood at the moment. Yeah, I fully agree with that. In the very short term, it needs to get under probably the 70, get under and hold under 70, 80. Then we might get a move down to that 40 area. So really, we're just popcorn watching for what's happening in this 20 pip range. But if it can't break 150 over the next couple of hours, maybe next few hours, I would expect to see a bit of a pullback, just because some of those buys and longs will give up on the fact that they can't really take the level out, and they're going to start getting a bit nervous, and they'll start exiting, and we'll get maybe a more of a sustained pullback. Where that goes before the dippers come in, who knows? It could be down at 60s, could be down at the 40s, could be down at 149. That's what we are yet to discover, and again, that's what the price action will show us. Right, we'll come back to looking at it in more depth, the prices, in a while. Let's get into some of the other comments and bits and pieces out overnight. Not a huge amount. Evans was out again saying, repeating, he still sees rates next year in the 4.5% to 4.75% range. Cash and carry, as they like to call him on the platform, was out again after yesterday. He's seeing little evidence of a softening in labour markets, and that surging mortgage costs are having a profound impact on the housing sector. Bit of a no shit Sherlock comment there. He was talking about the core yesterday, saying there's no signs of the core peaking. So he favours hikes until the core starts to cool. So keep on pumping until we see that core number. And to repeat, this is one of those little funny things that happens with central banks. They all talk about headline inflation, and then they switch to talking about the core inflation, because that is the more important one. It's the one they should be talking about in the first place. But the ECB were very good at that over prior years of talking about inflation. Then when inflation started moving higher and breaking their narrative, they moved to talking about core inflation, which was lagging behind and much lower. So the core is what's really important now. As we've been pointing out, headline inflation in the US has dropped 3 months on the trot. The core inflation has risen 2 months on the trot. So there is a bit of a disparity there. Now, Bullard was out with a comment. He's saying that the Fed has to get to the right rate level before moving on to data dependency. So slightly different from what we've got from Powell and everything, that all rate decisions are data dependent, etc. He wants to get rates up to a level first, then see what happens with the data after. So that's something. There's a bit of a difference, but Bullard is one who can go out on his own there. Over to the UK, BOE's Cunliffe said that they will set out the terms for selling the gilts that they bought up in this special gilt operation at a later time. So no signals there on what they want to do. A lot of Bank of England members are waiting for this budget to come out on the 31st, all the details on the 31st of October. Broadbent was out saying that the MPC will respond relatively promptly to news about fiscal policy. Again, this is something that they're waiting for. The Bank of England meeting is a few days after this government budget stuff is going to come out and going to get costed and going to get the thumbs up or thumbs down from the Office of Budget Responsibility. This is the one that the market will be paying attention to. From that, the Bank of England are potentially going to then decide on whether they need to hike more than they were previously, or if it's bad news, if it's good news, so on and so forth. So a lot in the mix there for the Bank of England over what rate increment they may go with. And Broadbent's just reiterating that they'll be waiting for that to see what happens, and they may go higher than they would do if it's bad news than if it's good news. He said that there's justification for the justification for tighter policy is clear, but it's not clear if rates must rise as much as the market expects. And again, given the political turmoil, rate expectations have been moving up. I think they were last at around 5.25%, as where the top for BOE hikes may be, led a lot by this political instability. So he's just reining in some expectations there about rates don't necessarily have to get as high as the market thinks. You may remember a few days ago we had Bailey out saying that rates might actually move higher than expected due to the inflation impact, which is coming in higher than they expected in August. So either way, we're probably still talking whether it's going to be 100 or 75s rather than 75s or 50s as far as the Bank of England go. But we'll see what happens with the other political ramifications from that. And on that front, it's probably no surprise to some of you to read in the papers what's going on in the UK, this absolute shambles, I'll call it. I've tried to keep it light as far as explanation goes, keep it more to market terms rather than try and explain exactly what's going on. But for people who are not in the UK now, you're probably looking outside window, looking in, wanting to know what's going on, what it means for the pound. So we had a vote yesterday on fracking. The vote was put forward by the opposition parties to dismiss having a debate about fracking licenses. They wanted to basically roll that back. They were against fracking licenses. They wanted to not have a debate on it. The vote was seen as a potential confidence vote for Liz Truss, i.e. you vote against her, you vote against the policy, you vote against Liz Truss. Anyway, the government won the vote, but it caused a whole big storm in Parliament. The long and short is the Conservative Party are fractured, and they're fractured probably beyond all repair at the moment. So the likelihood is we're going to be heading to a general election at some point. Now, what's happening is that there are several camps developing within the party. They've each got their own leader. Some of them are behind Truss, some of them behind Rishi Sunak, so on and so forth. The problem with changing a leader now is that whoever comes in will probably face the same situation as Truss has. So if Rishi Sunak came in, he'll face problems from all Boris's pals who are against him. So whoever comes in is going to face a section of the party who will be against them, and they will fight tooth and nail to do the same thing as they've been doing to Liz Truss. So really, the only way this situation gets sorted out is if the party manages to become more cohesive. There's a candidate that comes out who can unite the party. If that doesn't happen, and that's the way it's headed at the moment, we are going to be heading probably for a general election. The can is trying to be kicked until after this budget stuff is put through, so at least the government can say we've passed the budget or passed these measures. After that date, so October 31st, that's when we could start hearing about elections. Truss may resign in the meantime. It doesn't change anything because we don't know who's going to be leader and whether that's going to be cohesive for the party. Now, following on from that, the country is pissed off with the Conservatives, pissed off with the government. It's likely a general election would lead to a change in government. For the pound, it's going to be negative if Labour win and they take a big majority. Their policies are not market friendly. That will be seen in a negative light. The other situation is the potential for a hung parliament, and that will mean a potential government between the Labour and the other smaller party, the Liberal Democrats, again, not overly market positive. Probably a hung parliament is where I would say we're heading in any general election situation, and that alone will be negative for the political uncertainty. And I'm not too sure, even if the Conservatives gain a majority, whether any positivity for the pound would last, because they'd still be in a mess. So I hope that's given you just a bit of insight, without getting into the deep politics of it all, over what may happen to the pound moving forward over all this political rambling going on. And that's it for my headline rundown. Guys, got anything you want to add to that? Anything at all on the politics or what's going on in the Fed members or anything else?
Not really. I was actually surprised by Bullard saying, it was Bullard, right, who said that we're going to have to go on data dependent. We're not yet on data dependent or something like that. So basically, the opposite of what Powell has been saying. So that was a bit surprising. Also surprising is that Bullard is, he had been one of the most hawkish Fed members for sure. And he's now, the way I read his comments is that it's slightly on the, even though this comment that I just mentioned, that we have to go to not dependent, to not be dependent, to go to data dependent mode. That's not dovish, but overall he's like, he was talking about, the end of front loading is close, and we're going to do smaller adjustments and all that. So it kind of sounds a little bit on the soft side, but overall I think the Fed is pretty united, and they have been pretty united over the past year or so in the way they're coming across, and they are all coming across pretty hawkish so far. They are going to turn, but I'm going to say again, I think for people who expect, when is it, 2nd of November, the next meeting, people who expect Powell to turn dovish, I don't think it's coming yet. I think it's going to happen, but I don't think it's going to be this meeting.
Yeah, I agree. And one of the other comments Bullard said is that he won't predate which move he supports for December, even though he's been happy to put a number on every meeting prior to that.
Bullard is weird. He's a bit weird.
Yeah, he can be one that changes like the weather. He was pumping when the Fed started QE. He was pumping the possibility of big inflation coming. That didn't happen, so he swung the other way just as inflation then started to rise. So he's a bit of a wet finger in the air, man. Kay, you got anything you want to add?
Well, I mean, if you read just the headline, the headlines of what they've been saying, and here I'm going to go a little bit against my own view, but they all sound like not the pivot, but the pause is coming. If you read Bullard sees 2023 shift within the front-loading hikes. Evans, rates moving too high could have non-linear impact on the economy. Kashkari, Fed could potentially pause rate hikes next year.
Yep.
Are they signaling something here? I mean, this is the first thing that I was reading was the headline, okay? And of course, you got the Bloomberg spin and everything, but it does seem that they managed to kind of put the dollar a little bit, it's not lower. The dollar is not lower by any means. We are trading at highs in dollar yen. We're trading at highs in dollar China. We are not far from the latest lows in cable and the euro dollar. But I don't know. I mean, I was that surprised just reading those titles, and I don't know if they are signaling something, if they are starting to pre-signal that Powell may go a bit more, but he already said that they would be data dependent for the size of the next hikes, right? But I don't know. Would they be signaling, since we are closer to the end of the year, that they might pause in 2023? It's a possibility. So I'm still thinking that dollar may have a last surge into the end of the year, but I'm not sure about going forward. And we have to put like all those little pieces of the puzzle, trying to fit them in somewhere in the bigger picture. So they're not signaling a pivot by any means, but they may be somewhere signaling a bit of a pause. which would be enough for the market, which is desperately looking for the Fed to undershoot or to stop or to pivot. Which could be enough for the market to say like, oh yeah, this is the end of the dollar, so we are going to take I don't know, the dollar a bit to the other side, you know.
Yeah, I mean, personally, I don't think they're signaling anything new. We know that their high point is sort of, you know, anywhere from 4 to 5%. We were at 3 to 3.25% in the Fed funds rate. Another 75 puts us, you know, pretty much at 4%. A 50 after that puts us at 4.5. So I think naturally we're heading to where they see a potential top coming in rates. The question is whether they're going to be forced. Is inflation going to force them to go higher than that?
I agree on that, but there is what they say, there is what we think they might be doing with the terminal rates, and then there is what the market makes of it, right? And the market is desperately looking for reasons to sell dollars. Well, desperate. And at least the short-term market. The longer termers, I think they are just really. I think they are long dollars and just very relaxed about the whole situation. Dollar yen at the highs, dollar China at the highs, euro dollar well below parity for now, and things like that. So, but the short-term market may think it's a bit of a signal. So perhaps, and this is for once I'm saying this, perhaps being a little cautious with dollar longs if we trade short term. Perhaps that's the only thing. It's like, I still think in the end, if they go up to their 4.5, 4.75, it will still be 2% or so higher than what the ECB is ever going to do. So you're still going to be long dollars. So the fundamentals, because the data are not going materially worse in the US, wouldn't it be housing? But that's even worse elsewhere. So if you take like for like, the dollar is still the less dirty shirt in my fundamental view. But we can't rule out some short-term hiccups like we have seen. You know, we have seen the euro dollar print 95.5 when cable was collapsing, and then we went back up to close to 99. We are going to see that. And is it fundamentally viable? To me, not yet. But okay, because I'm still in the camp where QT is going to tighten financial conditions enough for. I'm a bit not scared, but I'm a bit worried to always try to find this pivot too early and to base trading upon that, and then finding ourselves come the month of mid-November into December, where people will say like, "Oh, bollocks! There's a dollar liquidity shortage," and all of a sudden dollar spikes. I don't know, another 5 or 6 or 7%. And we can't. But I mean, just for the day, I thought those headlines a bit special, really.
Yeah. I think, as I mentioned, I think that from here, I think the market is probably priced around right on where the Fed's going to get to. It's really going to come down to inflation. Is inflation going to peak? I think it's got more chance of peaking at the moment than perhaps 3-4 months ago when everyone was trying to call the pivot. So I think the pivot, anyone who's trading the pivot, that's still a move to fade, because even if inflation does pull back, unless we start seeing unemployment rising and the other factors they're looking for coming into play, the Fed's going to get to their ceiling, and they're going to stay at their ceiling for quite a while. So the pivoters are going to get punished again and again on any bad day too if it's not going to shift the Fed. So yeah, from that side, I don't see anything changing now. There will come a time, as Still likes to say, there will come a time when things will change, but I don't think it's yet. Right, we'll have a quick look at a bit of data that was out overnight before we get stuck into the price moves. Bit of data out on Japan, trade data. A little bit better on the trade balance, but we're still seeing the effects of commodity prices, the yen moves. I mean, look at those numbers. Exports up 29%, imports still 46%. Yeah, it's a little bit lower than previously, but these are big numbers, and it really does tell you what's going on in terms of what's driving these numbers, because it's all value of goods, a lot to do with obviously what's going on in the yen and prices. You know, normally you'd see this sort of thing for imports and exports, maybe running, you know, 5, 6, 7, 8% either side. But to see these big numbers, 45s, 29s, it's huge. So while the trade balance is looking pretty bad, there are big factors behind it that I think will wash out at some point. What do you make of those numbers, Kay? It's like bonkers, isn't it?
Negative, mate. Negative. And yeah, I mean, the numbers are high, probably due to the value of the yen. Also, they're still in a different time. In normal times, those would be pretty stellar numbers, because it would mean that the economy is running full steam if you see such kind of data, even trade balance. But because a negative trade balance is viable, but then in the case of Japan right now, it's not, because the currency is getting hammered, and the value of things is absolutely external. Of the external goods is absolutely exploding in Japan. So in this case, I still think it's not a good number. They are running a negative trade balance, negative current account balance. I don't see a fundamental reason to buy yen, really. I mean, you can play off takes if you think that's warranted, but I don't see any fundamental reason to be long yen. Zero.
No, I agree with that. And then we look at German PPI out this morning, still running very hot, much less on the month, only up 2.3% only, he says. Year on year, unchanged, 45.8%, beating expectations. You know, again, big numbers. I mean, if you see PPI, which can be a volatile number, sort of 7 to 10%, that's a big number in normal times. But the 45%, nearly 50% higher than last year. It's huge, and this isn't going away, particularly for the Eurozone. So that's still going to feed into the ECB. Quick look at yesterday before we get stuck into the prices. We had some housing data out from the US. The NBA numbers looking crap again. That mortgage rate up near 7%. As Kashkari says, that's putting pressure on housing. Applications down 4.5%. The indexes on the refis and the purchases continue. It's one-way traffic continuing to fall. One-way traffic all the way down. Starts and permits was a little bit mixed. Permits came in up higher, while housing starts fell. Now, permits are where people apply to build houses. Starts are where they call it where ground has been broken. Probably still some issues there with labour and supplies for housing starts, possibly in the numbers there. But also, given mortgage rates, given what it's costing people to now borrow to get housing, that could be feeding into that number there. But then permits suggest that their people are still plotting to build houses. So it's not wholesale hitting the market in those terms. On to Canada, we got CPI numbers there, and they have a 1,000 goes to try and guess what the number is there with all their common, trim and mean numbers. Overall, CPI is holding up. The common number there unchanged. One of the core numbers there was up a touch. Headline inflation down a point. Also the PPI numbers in there as well. Long and short, inflation isn't dropping back in Canada either. A percent here or a point here, point there isn't going to make much difference. The overall trend is that inflation is still entrenched in Canada. We did see CAD get a little bit bid, but then it got straight back on the US dollar bandwagon from that point on. Over to today, we've got the Philly Fed manufacturing. It's not been that busy week for the data this week. We'll keep an eye on the jobless claims. They've been ticking up a tiny bit again. We'll see if that continues, to see if the Fed are getting anything on their jobs picture. But the Philly Fed manufacturing coming in and existing home sales. Be watching the price components for that. Right, let's get into some of the price moves, and unfortunately, it's still a bit boring everywhere else. You know, a lot of sideways action going on, and you know, one of the cases in point, Aussie dollar. I spoke about, will we break this area up here, this 40-50 area? We didn't. That's another failure. We've got to move down to the low 62s. The fact that it couldn't get even down close to the big figure or this prior low here tends to suggest that there's a little bit of indecision, that the market's not willing to take this anywhere in particular either side. So gonna potentially see this sideways action consolidation keeping in play. If you're long like I am, you're not going to be wanting to see this level broken and a retest of these areas down here. That's going to potentially open the door for further losses. But on the flip side, if we do get a move and we see this bottom held again, that will be a strong signal that perhaps we are finding some form of longer term bottom. Maybe we get a move up. Still on the basis, we've got this range 63, 50, 40 down to the 62 big figure. Outside of that, we may get a move in direction. For me, again, it's still above 64 before we need to do anything. Similar picture for euro dollar at the moment. Let's give me the right chart. Sideways action again, you know, really sitting in between this sort of, you know, 96, 98 area. Can't make a decision either way. Will the ECB change this? They've really got to pull a rabbit out of the hat. I think so. We've come through many ECB meetings, even when they jumped to 75 pip hikes and expectations. You know, we still couldn't put a big bid on or keep it. So dollar is still king. It's going to take something special for at least the ECB to kick this. We're going to get conversations on QT. But for now, I really feel this is directionless. Got a bit of a, you could call it maybe a bit of a wedge building, coming off the prior highs. That's where you can be looking at as one of your upside levels. Just keep an eye on the low situation. Are we going to start forming a little bit a series of higher lows on there, and we'll see what happens when we get to the edges. I'll probably let Kay have a look at cable if he wants, because I'm still not really got any great interest in it. Given all the mess that's going on in UK politics, we're flipping around, big volatility still here. Kay, do you want to have a little look around?
Yeah, sure, mate. And I must say, I quite agree with Gavin and Mike. It's a case of taking, I call them beer peeps, and just trade the ranges. Don't forget to take profit relatively soon if you are trading them. That's basically what I've been doing of late as well, barring one or two very long term or at least longer term positions. But yeah, for the rest, it's follow the flow. Yeah, I'm okay to grab the screen unless Stelios has something that he wants to look at specifically. Or do you want me to pull up the screen still and then you comment about it?
Yeah, that's probably better. I don't have much to say. I just want to talk about one thing, and that's gold.
Okay,
and,
let me quickly have a look at the cable line, and then we switch over to gold. Okay.
Yes, sir.
So cable here, really we are. It's respecting this trend line of late. Little bit of an inside one, which held the debates today. So as I'm saying, respect that. We have to, of course, keep a very close eye on the political situation here when we trade it. But apart from that, data are not really great either. So and with my base view on the dollar still right now, I'm rather trading this, waiting for blips and then try to sell a bit into it and then buy them back below. And that's the way I'm scalping it. But as Gavin and Mike rightly say, I mean, take the pips right now for as long as there's a uncertainty everywhere. But for as long as those yields don't come down, to me, the thing is what I said in the room as well, is you basically versus most of what you can trade, you're getting paid to be long dollars and this is something that long-term traders rather fall back on when there's uncertainty, is that, and we've seen it in euro dollar, we've seen it in cable. You do the technical reversals, you do the positioning based reversals for a few figures, and then afterwards the move fizzles out, and we take the how shall I say, natural direction again, or at least the direction of the least resistance, which is that's where you get money. If you're long or short a currency, everything else equal, of course. Yeah, gold. Go ahead, Stel. What do you want me to put on, the longer term or?
No, just a daily. I think is fine. Or even a shorter one. Basically, what I want to say is that okay, we're up today, but the trend is still there, and it's with yields breaking out above 4% now, quite substantially. Now we're at 4.15 in 10 US. I think that risk assets and gold metals are going to be under pressure. So I'm very close to doing what I did when gold was about to break below 1680, which was good support. Now support is 1615, 1614, 1615. I'm very bullish gold in the medium term, but I'm going to take a short. If we get anywhere close to that level, I'm going to short the potential breakdown, obviously with a nice tight stop on the upside. And but I do think this is going to go in the short term, and I think if it does go, then $30 should be relatively quick. So or maybe more. So we'll see.
I've got this 15. What is it? 61, 62?
Yeah. I mean that's really the target. That's really the target. I'm saying if it does break on today or tomorrow, whenever it breaks, I think $20-30 is going to go in probably in one day. So just something.
We have something here as well. If it's really Armageddon. And
yeah, let me look at my weekly chart. There's a fib at 1510. There's a fib there. There's also, I mean, there's plenty of levels below, but the main thing, technically, I think, if it does get broken,
if you look at the 2016-2020 move, that's from the bottom $1,000 around to $2,000. The 50% is around this 1562.
Yep. Yeah, that's a pretty good level.
Perhaps you're looking at the pandemic low, and then
yes.
Okay,
yes.
Let me just quickly put it up on the side here.
Yeah.
And that is going to be 1588.
Let me check again.
And then I've got
and then 1522, which is also a sorry, no,
I don't see
hold
that.
on.
If you take the low on the pandemic spike, March 2020, then up to the 2000, I'm only seeing 1588 as the 78.6.
Yeah, there's the 88.6 as 1522, but it doesn't matter. There's a couple of levels there. I mean,
anyway,
it's not that important at this moment.
The prior low, it's probably going to take another another dive. And even visually, this picture doesn't look like a very bullish picture, right?
Exactly. And I think even though I'm bullish in the medium term, I think that this is a high probability move now. So so a nice, if we get close to these lows, it's going to be a really, really nice risk reward, because you're going to risk I need to see where I'll probably put the stop. You're going to risk $10-15 to make 30-40 to start. So I like that. I like that a lot.
Okay, mate. Thank you for that. Silver, it's kind of looking the same pattern, but then I've got those a little bit more affinity with silver, because of course gold is going to move a lot, but silver has the potential to really, if we ever find this and it could be just below $17. I think this is these are of course, the March 2020 low is much lower, but I don't know. It's for the really long term. Anyway, if we get anywhere close to $15 there, I'm not gonna be able to hold back. I'm really going to load up and put quite a bit of risk in there. But already here, I think around 16.90, 17 could be a decent level. But forces to admit, broken, retest, holding, coming back, broken, and retest here as well. And now we are like on the other one, and it looks like a step by step move lower again. And I do, as I'm saying, I am a little bit worried about an end of year squirt in the dollar. I don't know, Stel, you with your economic knowledge and stuff, do you think that the combination of what's going on now and then with together with QT and everything, that it would be possible to see like a dollar squeeze into year end?
We could definitely do that, and next week's or 2nd of November's FOMC could be a trigger for that. It is very dangerous. The question though is, how far does the Fed go? Because the Fed, I don't think they're idiots. They know that the world cannot afford to have a strong dollar for too long, and we're already seeing signs of this. You start with emerging markets, and then it kind of propagates everywhere, and you're seeing other currencies being in trouble, other countries being in trouble, basically because of this strong dollar. And we know that the world can't handle this for too long. So at some point, they're going to have to acknowledge it. They're going to have to do something, the Fed, I mean. And I think that's coming, not in November, but I think that's coming, early. I've always said, I think early, Q1 2023, when inflation will start dropping, and I do think it's going to start dropping quite fast. That's going to be the signal for the Fed to take the foot off the gas and just go neutral.
Yeah, I agree on that, but then you still end up with rates 4.5, 4.75, closer to 5%, and then brings me back to what Jay Powell says: some pain maybe have to be taken, and I think there's a possibility that there's still a bit of pain to be taken into year end, and I'm really thinking, because it goes a bit under the radar, but QT could be the clincher for all of a sudden. We've seen these numbers. Majed put them on as well, like the M2. We're seeing negative numbers in there, although there's still a lot parked in the reserve repo facility, because they are getting paid lofty percentages now without having to take any risk. But yeah, I mean, if there's any, and especially external dollar debt may all of a sudden need to be managed into year end, perhaps. So yeah, I mean, it's something that I'm keeping in the back of my mind, and I would not be surprised that we see something of the likes. But of course, everything in its own time. Yeah, thanks for that, Stel.
No worries, mate.
Yeah, so that's done. Euro dollar, nothing more to say. I think there's a bit of inside levels here, but really, I think it's going to be a case of trading ranges. Low 97s, then low 97s, then high 96s. And then on the other side, 98.90. So yeah, you have like 200 points to play inside. Today we are struggling to make even 15 points. But okay, it seems like the market's a bit tired and just a spectator of what's happening in yen and sterling possibly. The rest is pretty much covered. I do wanted to update this one. Especially also because we can't forget that Norges Bank is selling Norwegian kroner every day. It's helped again by I need to clean that one up a little bit. It's helped again by higher oils right now, but I do think in as we've seen, every time we are coming down to those lower 1040s, mid 1040s, dollar Norway seems to find support. I still think it's a very, very good zone if ever we get down there, to have a close look at it. Top side is now around, let's call it 1080. This trend line is pretty much invalidated, and I wouldn't be surprised to see a little push higher, especially if Norges Bank continues to press the pedal. I would not be surprised, let's put it that way, to see a move higher in this. And for the rest, really, the last one, I'm keeping a very close eye on this one, and I've had a couple of scalps here. Is this 25.45 zone on euro sterling? We had a quick look above. Went into the 100 moving average on the 4 hours, although I'm not a huge fan of moving averages. It looks to have a bit of following, a bit of an audience at times, really at times. Other days it doesn't mean anything. We shot a bit of a failure here. I'm quite interested to see what's happening in this 87.25, 87.45 zone on euro sterling. Of course, everything hangs on the on what's happening politically, but I still think this was an overshoot, and I rather like the long side on this one for the time being than the short end. Let's put it that way. And really, Ryan, I mean, that's it for me now.
Yeah, no problem, mate.
I just want to reply to Michael. Do you think the midterms can affect the dollar? Do you think it's bullish dollar depending on the results of the elections, of course? Well, I mean, there's a risk that in the elections that the Republicans regain some strength. I'm not sure whether that's going to be taken as bullish dollars, but or weakening of the majority in place. That's always like limit border. But if the question is, and one question that I've seen popping back a couple of times is that will Biden try to influence the Fed? I think Biden is actually supportive of what the Fed is doing to a certain degree. And it seems that Powell has been explaining things pretty well to him. So he's not really. So I don't think that because it's the week after the Fed, I do not think that we are going to see anything which is going to affect their decision for sure. So I think it's a bit of an open play what's happening on the midterms, to be perfectly honest. And here, the emerging corporations have liabilities in billions of dollars to be paid by the end of the year. They could front run fearing a more expensive dollar. Yeah, Mike, that's for sure a good argument, which I also think is a possibility to happen. You've got the Asian emergings, and then you probably have a lot of South America and even, you know, even in general, I think even Europeans, Japanese and stuff, they are having the same thing. Although there's been a few, at least a few wise heads in certain governments having covered quite a bit of their dollar debt through long-term maturity bonds. So some of them are covered. That's why I'm putting a real question mark behind the impression that I have, with what could happen. And with that, back to you, Ryan.
Yeah, thanks, mate. Yeah, I wanted to answer Michael as well. Biden is going through a lot of let's call it suppression policies into the midterms. You know, we know what they're doing with the SPR. Inflation is their big fighting point at the moment. You know, they've got the Inflation Act and that sort of stuff. They're releasing from the SPR to get gasoline prices down. This is all suppressing prices as much as possible into the midterms. I don't think anything can change between now and then. There's not enough time for any big changes to come in. So I agree with what Kay says, that unless there's any material gains by the Republicans that upsets the balance of power, this will probably just pass through without much fuss. The issue becomes afterwards, can they continue fighting inflation? Are these measures working? Or is inflation going to come running back? So on the political front, that's for another day. On the market front, we need to see whether inflation is going to carry on from that. But yeah, the midterms, I don't think there's a lot of big focus being put on it at the moment. But unless there's some real changes in seats, that will affect the market, obviously, as to what Biden's policies can get through. Right, I'm not sure I've got anything else to look at. Maybe have just a quick flick around some of the other things before we finish off. Quick look at oil. Again, not doing too much at the moment.
Ryan,
sitting in the middle of the bounce from the lows. Bit of indecision here.
Ryan,
as per yesterday, going to be looking at. Oh yeah, put the screen on. Stupid idiot. There we go.
Don't you speak about my friend like that.
Not talking to myself.
I know. You're my friend. Are you not my friend? Oh, okay.
Oh yeah, I am. I've got that. I've pulled these together. Yeah, and I don't know if someone can correct me. I think all this bid and stuff with the SPR, where they're going to be rebuying it, I think the official line is now below $70. It was supposed to be some 67 to 72 bucks, but now I think the official comment is they will rebuy back for the SPR, special petroleum reserves, below $70. So we all need to set our bids probably around 71. But in the meantime, just look at the prior low up to this 93 area. That's your range to trade in. Move either side of that, you're going to get a move there. Just to throw another few fibs at the gold situation that you guys were looking at. For myself, I've got this fib coming off this swing here, 2018. This was the fib, the 50 fib, 1617, that we pretty much held, give or take a buck or two previously. That to me is the potential break point, at least for the short term. We have held it a test, which is something you want to see. If a level is going to hold, you want to see a retest held, coming in, the buyers just above it, adds a bit more significance to the level there. But a break there, and yeah, I think Stell's going to be right. We're going to get a deeper drop from that point. As far as things go for the rest of the day, not a lot of data to say. The Philly Fed, probably the main item on the ticket. Keep an eye on this 149, 150 zone in dollar yen. Lots of eyeballs still on it to see what happens there. As ever, thank you very much for coming to the Flow Show. And do not forget to sign up for the Traders Summit program coming in. I shall just pop the link in the chat room. Where's it gone there? There we go. So don't miss that. Very much looking forward to it. Excited about this, and it's going to be a good event. I did my first one in April earlier this year, and yeah, some of the guests are pretty cool. So don't miss that one all weekend. And on that note, thank you very much, Stel, K-Man, and all you guys and girls for coming to the Flow Show. Have a great day as always, and we will see you tomorrow. Cheers, guys.
Thanks, everybody.